Cash flow strategies for tackling debt. Look, we've all dealt with debt before. If you haven't, you can stop the video right now. What I'm going to talk about today is the debt that's on our business. Sometimes personal debt too, all the principles will apply. But I want to talk to you about how you want to tackle that debt. Piece by piece, don't let it overwhelm you, the tools you can use, and we'll dive right into it. My name is Scott Peper. I'm the CEO and co-founder of Mobilization Funding. We make short-term construction loans to subcontractors, and we also analyze businesses. I'm going to share with you today exactly how we analyze debt for each business that we go about making a loan for, what we do, how we do it. And these are the same basic principles and practices that you can utilize for yourself. First, let's talk about assessing the debt situation. What does that even mean, right? Okay, for us, what it means is, what debts do you have? So anything you're making a payment on, okay? That's the first place to start. A simple debt schedule, which is basically a list of the different debt you have. It can be a mortgage. It can be equipment loans. It can be a term loan. It can be a working capital loan. It can be an SBA loan, an EIDL loan, any type of loan that you're making payments on, or any type of loan that you have to pay back. Maybe you're not making any payments on it. Maybe they've given you a 6-month or a year-long reprieve where you don't have to make payments. That just happened to us during COVID. The SBA didn't require loans to be paid for 6 or 7 months, and you could even extend them for a year or even longer. Doesn't mean it doesn't go on your debt schedule, just means you don't have a payment right now. What's important about a debt schedule is to list all of your debts down. Make sure you include the name of the company that you owe money to or the bank, the type of debt it is, term loan, line of credit, etc., equipment loan, whatever it may be. Then you want to assess what the payment is. Is it a monthly payment, a weekly payment, a daily payment? If it's weekly or daily, there's a video which you can click on below that will talk about merchant cash advance loans, which are the daily debit and weekly debit loans that are really bad for construction companies and most others too. But that's a separate video. Back to this one. The debt schedule, you want to make sure you have the type of debt it is, the payment type, monthly, weekly, daily, how much that payment is, what the outstanding balance is currently, and what the original balance was when you took out the loan. That's the basic, most comprehensive things you want to include on your debt schedule. And each one of those things is important because you want to not only know the total debt that you had incurred, but you also want to know what the total balance left is. And you want to know the term of that debt. So whether it's monthly, daily, or weekly, you also want to know, is it for the next 6 years? Is it for the next 1 year? What is the time period? And then next, total everything at the bottom. So you can see what your total monthly payments are, your total balance, and what the total debt was originally. That's first. Now, when you're assessing your debt schedule, or the debt load in general, you want to know how much is it costing you a month to service that debt. These are the types of things you've heard before where it's your debt service or your debt service coverage ratios. That debt service or debt service coverage ratio is based off of what is the cost per month to you or the business to service the debts that you have. Service means pay. If your monthly debt service is $10,000 across all these payments, and they're across different terms, maybe your SBA loan is $1,200. Maybe you have a loan that's $2,600, but it only has it only has 12 months left. It might make more sense for you to pay down certain loans versus others based on not just interest rate and cost, but based on the fact of what it might do for you operationally and cash flow wise. If your focus is to drive down, to increase your cash flow, you may want to hyper focus on paying off debts that are going to do that are lower cost, but will deliver to you a better cash flow in terms of benefit. Meaning, if it's better for you to pay off a debt that only has a 12-month balance left because it's going to add back $2,600 of money to your normal operational cash flow versus paying a higher cost debt off with a lower payment, you're better off adding cash flow if your goal is to increase cash flow. Those are the types of things that a debt schedule can help you assess when you begin the journey, and getting the information in one spot in a uniform manner for you or your advisors to help you with is very critical and key. Another component of assessment is your equipment schedule. What type of assets do you own? Equipment, machinery, vehicles, okay? Those things should go on a separate list. It's called equipment or asset schedule, okay? Those types of things all belong on your debt schedule as well. But if it's a true asset that actually it has a security, like a vehicle or like a piece of machinery or heavy equipment, you want to make sure you list that on your equipment schedule as well as what the debts are, and include not only what the purchased value was when you bought it, but what the terms of the debt are on it, the market value, estimated or accurate market value of what the equipment is today at the current period of time. And you don't have to assess this every single month, but maybe once a year you go through the equipment list and assess what the actual value of the equipment is. Any depreciation that you've taken against the equipment schedule, and then of course what the totals of the payments are and the totals at the bottom, so you can see what your total equipment and machinery or vehicles are. Those two schedules are going to be really important for you, because depending on what you can do or what options are available to you, you'll have different options based on those different debt terms. And again, depending on what your goals are, if you're trying to pay off all your debt, that's one thing. If you're trying to increase your operational cash flow on a monthly basis because your debt is too high, or your debt burden is too high, I should say, debt burden being the sum of the total payments, then you have some other options you might want to take advantage of, and we'll talk about those. But tackling them one at a time, these are the two schedules that can really help you start to assess where you're at and where you want to go and what options you'll have. Now, third, if you don't have a cash flow or a budget or an operational cash flow plan, that's the third thing you're going to need next. Without an operational cash flow plan, it's probably how you got yourself into a position that's tough to manage the debt load in the first place. So to tackle the debt load, you're definitely going to want to add into your world an operational cash flow. And what does that mean? Cash flow of your business is understanding how money comes in and how money goes out, how you're going to bring cash in and how you're going to spend the cash that you have as it goes out the door. It's very difficult if you just always kind of winging it. You're not able to forecast in advance. So a budget is going to be critical for you as well. The budget you have and the cash flow schedule that you have is what's going to allow you to understand what it actually takes to run your business on a daily, weekly, monthly basis. If you're trying to grow or you're going to grow, you need to know what that's going to look like over the future period of time and how much cash that's going to take. This is why your equipment schedule and your debt schedule is so important, because you might need other pieces of equipment. You might need to manage certain types of debt. It might not be the time to be aggressively growing at the moment. You're always going to need to grow because businesses either grow or die. But it might not be the time to take on the huge contract that you were going after. It might be time to take on smaller projects, but just more of them. Those are the types of decisions you can make when you're looking at your operational cash flow. So putting a budget and putting the cash flow together, which there's lots of videos that we have, and you can click on the link below for some of the budget and cash flow videos, or just go to our YouTube channel here and search cash flow or budget. But it's really critical for you to look through those things first and dive into the weeds and build that out. Because next, when you go to assess how you're going to tackle your debt, you're going to have that information you need in your budget and cash flow that will be able to forecast out the next period of time. Because you want to be able to answer the question for yourself, hey, I'm going to tackle this debt. How long is it going to take me to get me to this point or that point? It might take 12 months. It might take 18 months. And you're going to need your budget and you're going to need a cash flow forecast to figure that out. Now that we've gone through the debt schedule and your equipment schedule, now it's time to think about some of the options for lowering the cost of your debt or paying it off. First thing you can do is sell some of the equipment you don't need. Look, if you're on an equipment list and you've looked down there and you can see that there's something that you haven't used very often, you don't need or don't want anymore, or you're getting out of a certain, let's say, revenue stream of a business that you're just going to get out of, you're not going to use it anymore. Sell all the equipment and the assets you have related to that. Create some cash. Then you can use that cash to maybe pay down some of the debt or pay off some of the other debt. That example I gave you about a 12-month term left with a $2,600 payment. Well, what if that $25,000, $30,000 that you just sold for two pieces of equipment can be used? Not only have you sold that equipment and got that cash, but you've now used that cash and you've created by paying off the $2,600 a month debt, you've now created $2,600 of positive cash flow. Those are the types of decisions you'll be able to make looking at that. But when you're working with trying to determine which lender you might go with or you're going to talk to. You want to really look at all of your options because refinancing debt might come at a different cost, and you want to be able to build that cost into your budget. You want to know how that's going to impact you. Sometimes, again, if you're focused, and most businesses, this is going to be the case, you should be focused more on the operational cash flow of the debt than you are the overall cost. You have to pay attention to both. I'm not telling you to just sign up willy-nilly for as much debt as you can just to lower your financing costs, or just to lower your monthly payment at the expense of your overall margin. But you need to know both. And most often the stress and the pain that you're feeling on a daily, weekly, monthly basis is coming from your operational cash flow or the lack of operational cash flow. So if you can create positive operational cash flow in your business by restructuring your debt in a manner that's more congruent to the way you earn revenue or earn income, that is wildly advantageous to you and can really help you live and enjoy your life a lot better as a business owner. Again, now when you're negotiating with lenders, you want to know what terms you need to be most effective. That's what's key. You don't want to just start talking to lenders and only talk to them about cost, because you very well may be negotiating items, or they may be negotiating items for themselves with you that aren't even what you really need or are the most important. So know what terms you need. If you're looking for a 7 or 8 year term because you need it to be more congruent to your amortization schedule, your accountant has informed you that you need A, B, and C, or X, Y, and Z, you want to understand that what terms you're looking for. So it's much better for you to go in and say, hey, look, I'm looking for this type of loan over this period of time. The things that are more important to me are term of loan versus cost of loan. I care about cost, but I care more about term. What type of payments arrangements I can have in the first 12 to 18 months instead of the overall term. These are the kinds of things that you want to get advice on and know in advance when you're talking to lenders so that you can properly negotiate for your best benefit of yourself. You also want to know is because not every lender can fit what you need, and you want to quickly and efficiently be able to move through the lenders and find the right one and then start negotiating. Very often you can become exhausted with the process of trying to get a loan. We've all been there before. You talk to one lender, talk to another lender, you finally get sick of talking to about your business and what your business is and answering the same questions over and over again. The easiest way to avoid that is spend the time up front knowing what your terms are and the terms that will be critical for you. Spend the time with your advisors and your trusted resources to get that information together. And then you can effectively go to each lender and tell them and ask them exactly what you're looking for. The other thing I think is really important is put yourself in the lender's shoes. Think about, would you lend yourself the business? Would you lend your business the money you're looking for? And if the answer is yes, great. Put the story together for them that they should be looking at. Put the stuff that's important for you to highlight down on a piece of paper so that you can put yourself in that lender's shoes and say, hey, look, if I was a lender, this is the way I would look at my business. This is the way I would consider it. This is what's important for you to make sure you're aware of. These are the things that I'm going to be able to do well on, and these are the things I'm not going to be able to perform well on. Educate the lender on your business and why they should be giving you the loan, but more importantly, the things they need to be looking at related to your business so they can effectively give you a loan that's going to be beneficial for you. That's a really important item, and I think one most people miss. Let's talk about debt consolidation and refinance next. And the type of debt you're getting, does it add actual cash flow to you? Is it positive cash flow? For example, if you're adding debt to buy a building that's right adjacent to where your current property is, and half that building you're going to use, but the other half of the building you're going to rent out to another tenant, then that might actually be a good form of debt that actually is positive cash flow for you. Yes, you're adding debt, and yes, you're adding a cost to your business. But because you're able to lease that other half of that building out, it might not only support the actual new debt that you're incurring, but it might actually give you positive cash flow. And if that's the case, you want to make sure you're going to know not all debt is going to have a negative impact on your cash flow. So it's important to look through those things too. Second, on a refinance, you want to look at the overall cost. Are you putting a bunch of, had you grown your business up and you got a bunch of little tiny loans for each little piece of equipment, and now you got this debt schedule that's like super long and it has a ton of different assets on it and individual payments? Probably how most grew. That's okay. But when you're assessing consolidating that debt, you may want to understand really well if you combine all of those pieces of equipment, machinery together, or vehicles together, you may not want to put them all together if they're in different locations, or you might want to sell one of those assets individually, because if that's the case, you may limit yourself on the ability to do that. If you have a bunch of heavy equipment and it's all fixed inside of a building and it's not going anywhere, things like a crane inside of a steel mill, for example, probably doesn't matter. But if you have a bunch of lab equipment and they're for individual labs that go all over the place and they move around and they're very portable, it may not make sense to combine all those together because you may be selling them. They might not have a life cycle that's long enough to make sense to refinance. So those are the types of things you can rely on your professional advisors for. But you also want to make sure you're considering. And also, don't rush it. You can't solve your debt problem in one day, right? So you don't necessarily want to just go take one big loan out and pay everything off. Look at it realistically. You didn't accumulate all that debt in one day, so you don't need to try to pay it off all in one day. So just try to relax and try to figure out how you can help take the pressure off of whatever it is that's causing you. Like I said, it's usually the monthly debt burden more than it is the total debt load. And you also want to consider that when you're trying to make the decision. So give yourself some grace. You're not going to do it overnight. Let yourself take some time to figure this out. And when you do figure it out, know that it's going to take a little bit of time before you're actually in a great spot with a lower debt load and you've managed it to the goal that you've set. Now you've figured these things out, it's time to make a decision and then execute that decision. And when you're executing that decision, don't forget to celebrate some of the small wins. When you do pay off a certain debt and you've now gotten to the first phase, maybe the first phase is you've lowered your operational debt burden by a couple $1,000s. Celebrate it. Enjoy it for 24 hours and look forward to the next phase. Maybe the next phase is 2 months away when you pay off another debt, one of the other debts, and that increases another couple $100. Enjoy that too. Maybe you enjoy going out to lunch that day. But celebrate those little moments along the way because that motivation will help you stay on track. And lastly, to bring all this together, we've talked about a lot of items related to debt consolidation, what debt is, how you want to tackle debt, good debt, bad debt. Does it add cash flow? Does it take away cash flow? What's important and what I want you to take away from this video is operational cash flow is usually where your pain and your enjoyment is going to come from when it relates to your debt. Don't worry about the overall number of what you owe as much as you are worried about the operational cash flow. You want to look at both, and they're both really important. But operationally, what is it costing you to service the debt you have? And how can you help impact that while considering what's best for your business in the overall amount of debt that you're putting on your business or taking away from your business? Or trying to consolidate. I hope this video helped you. We talked a lot about cash flow, a lot about debt consolidation. There's a ton of videos about both of those on our YouTube channel here you can find. But if you like this video, please share it with somebody and subscribe. And I look forward to talking to you guys again soon. Thank you.